Your journey to stock market success can be, well, pretty intimidating at first. But, it's also a powerful tool for building wealth. By understanding some key strategies, you can really unlock its potential. Today, we're diving into two powerful strategies that are perfect for beginners: selling cash-covered puts and credit spreads. Now, these strategies might sound complex, but don't worry. We'll break them down into simple terms. By the end of this essay, you'll have the knowledge to start exploring these strategies for yourself. Remember, investing always involves risk. It's essential to do your research and understand the potential downsides before making any investment decisions. So, let's get started on your path to mastering the stock market. Before we dive into the specifics of cash-covered puts and credit spreads, it's crucial to understand the world of options. Options are contracts that give you the right, but not the obligation, to buy or sell an asset at a specific price, known as the strike price, by a specific date, the expiration date. There are two main types of options: calls and puts. A call option gives you the right to buy an asset, while a put option gives you the right to sell an asset. Cash-covered puts and credit spreads are strategies that involve selling or writing put options. By selling puts, you're essentially acting as an insurance provider for other investors. And just like an insurance company, you collect premiums for providing this insurance. Selling cash-covered puts is a popular strategy for generating income and potentially owning stocks at a discount. It involves selling a put option while simultaneously setting aside enough cash to buy the underlying stock if the option is exercised. Here's how it works. Let's say you're interested in owning stock in company XYZ, currently trading at $50 per share. You believe the stock is slightly overvalued, but would be happy to own it at a lower price, say $45. You could sell a cash-covered put option with a strike price of $45. By selling this put, you're essentially saying you're willing to buy 100 shares of company XYZ at $45 per share before the option's expiration date. In return for taking on this obligation, you receive a premium upfront. If the stock price stays above $45, the put option will likely expire worthless, and you get to keep the premium. If the stock price falls below $45, you may be assigned the shares at $45, which you're prepared to buy with the cash you set aside. Before we go any further, it's crucial to grasp the components of an options contract. Each contract represents 100 shares of the underlying stock. The premium is the price you receive for selling the option. This is yours to keep no matter what happens with the stock price. The strike price is the price at which you agree to buy the stock if the option is exercised. And finally, the expiration date is the deadline for exercising the option. Understanding these elements is essential for making informed decisions when selling cash-covered puts or any other options strategy. Section 5. Step-by-step, selling your first cash-covered put. First, choose your stock. Select a company you understand and wouldn't mind owning. Next, determine your risk tolerance. Decide how much you're comfortable potentially losing if the stock price drops. Then, select your strike price. Choose a strike price representing a price you're willing to pay for the stock. After that, choose your expiration date. Pick an expiration date that aligns with your investment timeline. Finally, sell the put option. Use your brokerage account to sell one put option contract for the chosen stock, strike price, and expiration date. Remember, always have enough cash in your account to cover the purchase of the stock if the option is exercised. Section 6. Credit spreads. Enhancing returns with defined risk. Credit spreads offer a way to further manage your risk while still generating income from options selling. Instead of selling just one put option, you simultaneously sell and buy put options on the same stock with different strike prices but the same expiration date. This strategy is called a spread because you're profiting from the difference in premiums between the two options. because you're selling a put option with a higher strike price and buying a put option with a lower strike price. You receive a net credit up front. Section 7. Mastering Credit Spreads, a practical guide. Let's break down how to execute a credit spread. Imagine company ABC is trading at $100 per share. You believe the stock will stay above $95 in the short term. You could sell a put option with a strike price of $97 and simultaneously buy a put option with a strike price of $95, both with the same expiration date. Since the put option with the higher strike price will have a higher premium, you'll receive a net credit when opening the trade. If company ABC stays above $97 by the expiration date, both options expire worthless, and you keep the credit as profit. If the stock drops below $97 but stays above $95, you may need to manage the trade, but your losses are limited to the difference between the strike prices minus the premium received. Section 8. Conclusion. Your path to financial freedom. Selling cash-covered puts and credit spreads can be valuable tools for investors of all levels. By understanding these strategies, you can potentially generate income, reduce your cost basis on stocks, and manage your risk more effectively. Remember, thorough research and a solid understanding of options are crucial before diving in. Start small, practice with paper trading, and gradually increase your exposure as you gain experience. The stock market offers incredible opportunities for those willing to learn and apply proven strategies. Take the first step on your journey to financial freedom today.